Okay. Market tried to shake it off a little bit of a bid there, and bonds didn't go red. They did catch a bid. Oh, your humble host might have finally made a good trade today. All right, let's talk Intel. 14.26 billion. Okay, no rally though. Estimate was 13.8. I mean, maybe the margin is a problem. Gross margin 36%. Maybe expectations are more like 39. First quarter revenue outlook a little bit shy, 12.7 to 12.85. I mean, I don't know, Kevin. A beat for Intel, I feel like, is at least, even if it's on the trailing, that's a pretty good little beat there.
Yeah, it's all about the guidance. Actually, pretty much in every single metric, they came up short when it came to the guide for Q1 here. They're looking for Q1 adjusted earnings per share to sit at flat, $0, and the street was looking for 9 cents. Q1 revenue, 11.7 billion to 12.7 billion. Street was looking for 12.87 billion. Outlook for gross margins, 33.8%. Street was looking for 39.12%. You kind of get the gist here. The guidance is really what they missed on, even though they actually had a pretty decent quarter for Q4. Commentary, as Caroline was kind of talking about, the commentary as far as leadership could also kind of drive the stock if we do get some positive comments there. But unfortunately, this is still a stock that's just hasn't been able to catch a bid, hasn't had the ability to get some good news. And unfortunately, today just doesn't seem like it's the day for right now.
All right. I guess you're a little harsher on it than I would be. What do you think, Caroline?
Yeah, I was just looking at the commentary. Obviously, they try to spin it pretty positive to start, and it was a beat on both the top and bottom line, as you said, for the trailing numbers, but said the fourth quarter was a positive step forward as we delivered revenue, gross margins, and EPS above our guidance. The interim co-CEO and CFO of Intel said basically we're driving toward greater returns on our invested capital, improved profitability. Our Q1 outlook reflects seasonal weakness magnified by macro uncertainties, further inventory digestion, and competitive dynamics. We remain highly focused on execution to build our progress and unlock value. So, certainly talking about the fact that there are some headwinds there weighing on that Q1 outlook, possibly why it's disappointing. Because Intel is negative year to date, not by all that much, but is down over 50% over the past year. You never really know how investors are going to respond given that, and it looks like it might be catching getting a little bit of a bump. But we'll have to see after the earnings call too. And like I said, if there's any more clarity in terms of leadership moving forward, if it's less interim and more permanent, I think that would be a good thing for Intel.
I kind of like the idea of co-CEOs running the company, having kind of multiple minds, people from within for the moment. But at the same time, I also wonder if they're having trouble finding someone to run this company. I don't know. I mean, I feel like there's always going to be someone willing to take on a challenge, but that to me is a little bit kind of not necessarily negative, but it's certainly not positive to kind of have like a mashup team still in place. But the other thing too is seasonality and blaming cyclical stuff is like, come on, guys, you're not fooling anybody. Like, what do you think? We've all been sleeping under a rock the last year? This is like the biggest cycle ever since .com for like computational power. So that's ridiculous. I mean, I know there's probably some actual seasonality to chips, KG. Correct me if I'm wrong.
Yeah, there's a little bit of seasonality, but unfortunately,
that's not the problem,
client
right?
side. Well, I mean, the client side chips, which is what they deal with right now, it's in a recession right now. And actually, DeepSeek gives a little bit of an opportunity for these stocks. That's why AMD has gotten a pretty decent bid over the last couple of trading sessions, because if you have chips that are able to operate these large language models on PC, then that may accelerate the refresh cycle. Well, Intel, I'm surprised they have not gotten on that bandwagon, at least try to talk around.
That's what I'm saying. So even though, again, I think the numbers are kind of reassuring, actually, that maybe there is a tourniquet to the bleeding for Intel, and the shares are trying to move a little bit higher. But saying seasonality when you're in the wrong market is like going to the desert and complaining about seasonality. Like, you're in the spot where it doesn't change. Let's talk Deckers here, Caroline. You might have to go buy some more Uggs because they dropped to $199 after rallying into the report. But, I mean, this thing's been on a total tear. And sometimes we get this with shoe companies in particular where they get hot for a little bit and then they get one maybe little slight disappointment, and then the market kind of thinks maybe they're losing their cool factor. But I don't know, it didn't look terrible. They beat the sales on a trailing basis, 1.83 billion versus 1.73. But maybe something here in the outlook or something I'm missing. It's still almost 20% growth on an annual basis.
Yeah, and the full year 2025 revenue growth guidance was raised to 15% growth. And previously, back in October when they reported, they said they expected it to increase approximately 12%. So top line guidance actually looks pretty good. You mentioned the trailing numbers. It's for sales, 1.83 billion. They said that was a record that topped the $1.73 billion estimate. That was an increase of looks like 17%. So still seeing, healthy double-digit revenue increases. I'm looking for the breakdown here, but they're talking about the exceptional results in the third quarter, record quarterly revenue, gross margin, and earnings. I think that if you take a look at the I had mentioned the net sales increasing 17%. Direct-to-consumer net sales increased almost 18%, and then wholesale sales increased about 16%. So I think that, it also could be, I'm just going down here, UGG increased 16%, Hoka 23.7%. That actually, it's technically a sequential decline. It was 34.7% in the second quarter, second fiscal quarter. Teva up 6%, and then other brands decreased about 17%. I know that they had another brand that basically looked like Hey Dudes but wasn't. That was definitely a weak spot. But I think, it's important to remember, as you already said, this is a name that's up more than 70% over the past 1 year. It's up 10% so far in 2025. It's at an all-time high. And, I'm seeing weakness, so maybe it's just that it was priced a little bit too much for perfection. I don't know. Kevin maybe sees something else that stands out.
KG, hey, dude. What do you think?
It could be their margin guide. I don't have if you're kind of looking at their full year margin guide, they're looking at gross margin sitting at around 57%. If you're looking at it for this particular report, it was a little higher than that. So maybe that kind of scares the street a little bit. And then the wholesale business has seen good performance, in the last couple of quarters, but that has been a drag if you kind of look at the longer term time frame. So maybe the market wanted to see a little bit more of a acceleration there, like the growth rates that we've seen in the previous quarter. But outside of that, I don't see anything in this report that would warrant the move to the downside. But once again, this is a stock that's been doing fairly well. And as you talked about, competition, the cycles go very, very fast when you're looking at apparel and shoes and things of that nature.
Okay. Yeah, the shoe trade's been a fun one to watch because it seems like one of those places where we do kind of splurge for ourselves. I feel like myself included, though I don't buy like super high end. I just buy a lot of the cheaper ones at Nordstrom Rack, etc. But it is kind of like one of those like casual luxuries, I feel like, Caroline, that we've seen show up in a lot of these brands. But if you recall, like you mentioned, you like the Ons, and I do too. That stock has had quite a bit of volatility. So anything's possible, I feel like, for Decker to some extent, because you've kind of had some stop and go with some of these. But ultimately, like they come back. They've kept grinding back.
Well, and I think also yes, some volatility, although On is still up, 16% this year, 130% over the past 1 year. So I think it's just a matter of how much higher can these names run. They were huge winners in 2024. They've been, big winners so far in 2025. I was just taking a look just to get a sense. Obviously, this could change now that they've actually reported. But, it looks like about 60% of analysts still rate Deckers as a buy. The median price target was $224 heading into this report, though, which was an uptick from the end of last year, but it closed right around $223 today, so very close to that. So I think it's just going to be, I know that analysts can be wrong. We definitely point that out on the network quite often, but I think that it's going to be, are these results strong enough to get people to, investors to want to keep buying and analysts to maybe change some of those price targets?
I think as long as it's not like a gimmick, like some of these have been, like, I don't know, I've always kind of thought Crocs were like a little bit of a gimmick, and eventually that
people who
came
wear
back down
Crocs
to earth.
Love Crocs, and I know that parents love Crocs for their kids. I will say, like, Uggs have always been my most comfortable shoes. I went probably a decade without ever wearing Uggs. They just kind of phased out, and now they're back in. So I think that even if they're not gimmicks. I mean, as we've seen with so many Abercrombie, so many of these brands, it's like, obviously the marketing plays into it. Hey, look at Chili's. Everybody's going back to Chili's, and it was kind of, not a name that you would necessarily talk about all that much. So it's all, it ebbs and flows, right?
For sure. And Crocs has ebbed a little bit lower while the other ones have flowed a little bit higher. I mean, the Hoka's 24% is incredible. They're doing amazing. Let's talk Visa here, because a lot of people are buying these shoes, these kind of casual splurges for ourselves on our credit cards. So the swiping transactions we expect to generally still be pretty big, especially after what we saw from MasterCard. Visa's ripping right now, 352. Wow, and that's already rallying after MasterCard. So what did Visa tell us differently here, KG? Does something jump out to you?
I'm reading it right now. It's Q1 payment volumes.
But that's all I see, really.
Yeah, so Q1 payment volumes increased by 9% on constant currency, which is pretty good. Outlook for Q2 net revenue growth, high to single digits to low double digits. I think that's also a positive. This is a company that really doesn't post double-digit revenue growth like that. Q1 processed transactions increased by 11%. I mean, they're seeing the demand. They're doing really well, not only here in the United States, but around the globe. I think the international travel story is also complementing their growth right now. And, you can make the case that the stock's a little bit stretched when it comes to valuations, but when you get earnings like this, it really kind of, offsets those concerns. And until they have a hiccup or we have a situation where consumers stop spending or slow down spending, they're going to be a direct beneficiary of this. So this is actually a really good report. They do call out, obviously, Thanksgiving, Black Friday, and Cyber Monday were also huge catalyst drivers for their performance for the quarter.
Okay. And to the point on growth, it's the first double-digit growth they put in for a quarter since Q4 2023. So it's been a solid year since they've had this type of pace. So that is an indeed pretty impressive number. And everyone expects it to basically stay there. Analysts, I think, feel like you'd have to be nuts to be betting against Visa right now with the momentum, and there really are very few people doing that. There's one seller rating on Visa, 83.3%. 40 analysts out of the 48 all say to buy this stock. It just feels like one of the more no-brainers to me. Hopefully I'm not violating any compliance here by saying that. What do you think, Caroline? Am I going to get in trouble?
I'll let compliance maybe weigh in.
Right? It goes straight up. The jobs are good. People keep swiping. It's like, I can't figure out the bear case. You know me, I'm happy to always argue the other side, but I don't know what it is for Visa.
I don't think that. I mean, yeah,
don't even have the credit
I see
risk.
About the same 85% buy. I mean, the median price target is only a couple dollars away. It's $348.50, so only a few dollars away from where it closed. But I do see, Bernstein's at $378, Wolf is at $375. So I mean, there's definitely price targets higher than that. I think that this isn't a huge surprise based on what we heard from from MasterCard as well. Especially MasterCard was talking about strength in January in U.S. spending specifically, and Visa has more of a U.S. focus than MasterCard as well. So it'll be interesting to see what they have to say about current spending now as well. I think the other thing, I don't know if you saw or talked about that now Visa has this partnership with X as well, the X Money account, which basically allows you to do peer-to-peer payments and do that type of thing. So it'll be interesting to see what they have to say just in terms of new partnerships and such like. But I think that no huge surprise here. The big question is, will the stock rise given how far it's already run? And it looks like it's going to continue the rally.
That's why I'm hyping it up, because I thought I already had the move kind of baked in. Again, Discover or Capital One, where you've got potential credit risk, fine. I can argue the bear case for that, but it's hard to figure it out for Visa. Go ahead, KG, real quick.
Yeah, no, real quick. Cross-border volume was up 16% year over year, which is remarkable. And I think that complements what's happening with the airlines and why these airline stocks have moved up. So that's probably really the icing on the cake for this earnings. And you can look at pretty much every segment, but cross-border volume itself, that's mid double digits. That's something that I haven't seen printing from Visa in a very long time, ex COVID-19.
Yeah.
But MasterCard was 20%, so.
True.
A lot to go around.
Bigger base, though. Visa has a bigger base than MasterCard does.
It's a big pie. Travel. I gotta get overseas while the dollar's still up. Though I guess if we're going to keep heaping tariffs on people, it's probably no rush for it. Appreciate it, guys. Thank you very much. Nice work, Kevin Green and Caroline Woods. One more company there, Atlassian, ticker TEAM team, having a nice aftermarket session, up to 310 after closing at 266. You do the math, big numbers, and that's going to be an all-time high for Atlassian. Yeah, for sure, because we did actually see a dip in the stock earlier in the year, or rather at the end of last year. So it's just going to run straight up, basically, past the old high of 288. That's a big pop for Atlassian as the software business reported pretty good numbers. I'll run you through them just real quick. And by the way, this is a company that has not had persistent profits on the bottom line, so it's a valuation game very much so. But the enterprise business did report numbers that seem to satisfy and exceed handily. 96 cents on the bottom line. Street was looking for 76. Margins. Outlook improved, 84.5 versus 83.5, which was the expectation. Everything well above the expectations, including a revenue guide for next quarter of upwards of 1.35 billion. Street was looking for 1.32, and their trailing data center revenues beat by about 12 million on an expectation of 350. They delivered 362. Atlassian crushes it. Apple's up next.